You're tuned in to the deep dive. Today, we're getting into a really key part of the Indian economy, the industrial sector.
hmm
We've got our hands on this pretty detailed equity research report from Goldman Sachs. It's from April 2025.
Yeah, quite recent.
And our mission really is to boil down the most important takeaways for you. Cut through that financial jargon.
Absolutely. Understand what's actually happening, what the potential looks like.
Mm-hmm.
This report's got everything, sector outlook,
Stock
valuations,
picks, too.
stock picks, risks,
Yeah.
strategy,
Mhm.
the works. We're basically trying to filter out the noise and give you the core insights from Goldman's perspective.
Okay, good. So let's dive in. The report seems to start with the big economic picture. It mentions slowing global demand and, interestingly, rising tariff uncertainty.
Yeah, those are the big headwinds they flag right at the start.
So for someone trying to get a handle on this, why are these global things the starting point? Why do they matter so much for Indian industrials?
Well, think of it like a tide, right? When the global economy slows, it kind of lowers all boats to some extent.
Okay.
And this uncertainty, especially around tariffs, it directly hits business confidence. Companies become less willing to make big investments.
You mean capital expenditure? CapEx.
Exactly, capex. If you're not sure about future sales, or if you might get hit with new tariffs, you tend to pause those big plans, like building a new factory or buying major equipment.
Right. And the report says that hesitation is actually being felt pretty widely across India's industrial scene now.
Oh, definitely.
Huh.
It's not just theoretical. They point specifically to delays in private sector capex hitting several areas.
Such as?
Capital goods, for one, the machines that make other things, also infrastructure projects, ports, and perhaps obviously companies that export a lot.
So they're all seeing fewer new orders coming through the door.
That's the picture, yeah. Businesses are just being more cautious with those big spends. It's fascinating to see how those global ripples land domestically.
But it's not all doom and gloom, is it? There's a potential silver lining mentioned, something about interest rates.
Yeah, that's an interesting point. The GS Economics team, their own economists, are forecasting some interest rate cuts.
How much are we talking?
They're predicting a total of 100 basis points. So a full percentage point cut eventually, with maybe 50 basis points, 0.5%, happening in this calendar year, 2025.
Okay, and how would that help?
Well, lower rates mean cheaper borrowing costs for companies. Simple as that. It could give them the nudge they need to, finally greenlight some of those delayed investment projects. It can boost medium-term capex.
So a bit of a drag now, but maybe some relief coming down the pipeline. The report also mentions something about the overall pace of capex growth slowing down after a strong run. What's that about?
Right. So India's had, 3 pretty strong years of growth in gross fixed capital formation. That's the overall investment in assets like buildings, machinery, infrastructure. And now that growth rate is naturally starting to taper off. Specifically, they mention investments in building new factory capacity are being put on hold somewhat.
Is that necessarily bad news?
Not entirely. It could just mean a shift from a maybe unsustainably high growth phase to something more steady, a natural leveling off after a big surge.
Got it. The report also zooms in on how sensitive ports and logistics are to global trade flows, which makes sense, obviously, but that container core stat really stood out to
The
me.
60% one.
Yeah, 60% of their revenue is from exports and imports. That feels like a huge exposure.
It really is. Just export-import activity. It perfectly illustrates how vulnerable those sectors are to any turbulence in global commerce.
So the risks they flag around a U.S. slowdown or tariff issues become even more pointed then.
Exactly. Because the U.S. takes, around 18% of India's total exports? So any significant dip in demand over there or new trade barriers, well, it's going to directly hit volumes for Indian ports and logistics firms.
Okay, let's shift focus slightly. How is all this translating into company valuations and earnings expectations? Are analysts getting nervous?
It seems that way, generally speaking. The report notes that average earnings estimates for the companies they cover in this space, looking out to FY25, FY26, FY27, have been trimmed
By how much?
by about 1% to 6% across the board.
Yeah.
It's a broad downward revision.
Reflecting that slower growth and the pressures we've been talking about.
Precisely. The basic expectation is just slightly lower profitability in the next few years because of these headwinds.
And drilling down, there are some specific company calls that seem pretty significant. L&T, Larsen and Toubro getting downgraded. That feels noteworthy.
Yeah, L&T is often seen as a bellwether, right, for Indian infra. They've been moved to neutral.
What's driving that?
Seems like a few things hitting at once.
Yeah.
Pressure on their profit margins, some delays in orders actually starting, and like we said, that weaker global appetite for big capex projects.
And their target price was cut too.
Yep, 12-month target price reduced. It just signals a more cautious view on them, at least for the near term.
But then on the flip side, KEI Industries gets an upgrade to buy. That seems to cut against the grain a bit.
It does, and that's what makes it interesting. The rationale for KEI seems to be heavily valuation-driven,
Meaning,
meaning their stock price has taken quite a hit, down, I think the report said, 43% in 6 months.
wow, okay.
So now, trading at about 26 times their forecast FY27 earnings, Goldman sees it as being near trough levels. The valuation looks attractive.
Well, the thinking is the bad news is already priced in, maybe.
That seems to be a big part of it. Plus, they might see more resilience in KEI's specific markets, things like domestic demand from infrastructure, EVs, real estate maybe, and also export potential. The risk-reward looks favorable now, basically.
Interesting. And what about cables and wires as a whole sector?
Well, the report notes that their multiples, their valuations have corrected a bit too, but they're actually still above their long-term median levels.
So still maybe a bit pricey compared to history.
Potentially, yeah. But the positive factor they highlight is the export opportunity. That's seen as a potential tailwind for the sector.
Okay. And for ports and logistics, valuation-wise?
Given all the trade concerns we discussed, they're apparently trading near the lower end of their historical valuation bands.
Which could mean an opportunity for longer-term investors.
Potentially, yes. If you believe global trade will eventually stabilize and recover, current valuations might look appealing.
All right, let's get to the specifics. The top picks. Goldman flags 5 companies with buy ratings. We know KEI is one. Who else makes the list?
Okay, so alongside KEI, the other buys are Adani Ports and SEZ, Ultratech Cement, Blue Dart Express, and Interglobe Aviation.
Okay, quite a mix there. What's the logic for Adani Ports?
For Adani Ports, the argument is pretty much centered on growth. They expect mid-teens growth, mainly driven by their existing ports ramping up operations and handling more volume.
Even with the short-term trade worries.
Apparently so. They see the ramp-up potential as strong enough to drive growth, despite maybe some near-term disruptions.
Okay, Ultratech Cement. That seems slightly counterintuitive if construction capex might be weak.
That's a fair point. But for Ultratech, the key driver, according to the report, is falling input costs.
Ah, like energy and raw materials.
Exactly. Lower costs are helping their margins, kind of offsetting the potential softness in demand from construction. So it's more of a cost story for them right now.
Makes sense. Blue Dart Express. Logistics, tied to the economy. What's the positive angle there?
For Blue Dart, it seems to be mainly about lower fuel costs. Fuel is a huge expense for logistics companies.
Right.
So lower fuel prices are giving their margins a nice boost, even if overall economic growth is a bit slower. It's another specific cost benefit playing out.
And finally, Interglobe Aviation, Indigo's parent. Why is an airline in industrials reports top picks?
Yeah, it's a bit of an edge case, but aviation definitely has industrial links. The rationale mentioned is an improved market structure, less intense competition maybe, plus the benefit they also get from lower oil prices.
So favorable industry dynamics and cost tailwinds.
Seems to be the gist of it, yes.
Now, equally important are the stocks that aren't favored. We talked about L&T moving to neutral. But Cummins, Thermax, Container Corp, they're rated sell.
That's right. Either maintained as sell or downgraded to sell.
And the common theme there is?
It really comes back to that capex sensitivity. These companies are seen as being more directly exposed to the slowdown in new industrial investments and the broader capex headwinds we've been discussing. Their fortunes are more tied to that cycle.
Okay, that's clear. Let's dig into the risks then. The report really emphasizes this tariff uncertainty. Just how big a deal is that?
It's presented as quite significant because when global tariff negotiations drag on or the outcomes are unclear,
Businesses just wait and see.
exactly, they get hesitant about committing to big long-term projects if they don't know what the future trade landscape, the future costs will look like. It really dampens capex confidence.
And then there's commodity and fuel volatility. You mentioned lower prices helping now, but the volatility itself is a risk.
Right, it's a double-edged sword. The current lower prices are great for margins for some, but these markets are inherently unstable. If prices were to spike back up suddenly, those margin benefits could evaporate pretty quickly, so it creates earnings uncertainty.
The report also flags a potential slowdown in government spending, adding to the private sector capex moderation.
Yes, they mentioned an expected moderation in private capex, which we've covered, but also potentially in public sector capex too. If both slow down, that could obviously reduce the overall pool of new orders for many industrial firms.
And going back to trade, just the general exposure remains a key risk, right? For container volumes, port traffic.
Absolutely. If importers globally remain cautious because of economic uncertainty, that directly means fewer containers moving, less activity at the ports. It's a straightforward impact on revenue for those businesses.
And lastly, they mentioned some sector-specific risks, EMS and cement.
Yeah, just briefly. For electronics manufacturing services, or EMS, the risk is about staying competitive on cost globally and navigating those tariffs effectively. Their export business is vulnerable there.
Okay.
And for cement, the specific risk flagged is the potential for too much supply excess capacity building up maybe in the first half of FY26, supply potentially outstripping demand for a period.
So lots of layers to the risk picture. The report then makes this distinction, tactical versus strategic views. Can you break that down for us? What's the difference in this context?
Sure. So tactical calls are usually shorter term, think maybe 6 to 12 months out. They often focus on things like recent price moves, specific catalysts, or maybe where the market seems to have overreacted.
Like a trading opportunity almost.
Sort of, yeah. Whereas strategic or structural views are much longer term, looking out 1 to 3 years, maybe even more. They're based on fundamental, lasting trends or shifts in the market.
Okay. So what are the key tactical calls Goldman is making here?
Tactically, KEI stands out again, seen as that rebound trade after the correction, with solid domestic drivers.
Right.
Adani Ports is viewed tactically positive because of that ongoing port ramp-up. Blue Dart gets a tactical nod due to those lower fuel costs helping margins right now. And Interglobe, also tactical, given the current aviation market conditions and oil prices.
Any tactical avoids?
Interestingly, yes. They suggest tactically avoiding L&T for now, mostly citing that lack of clear visibility on new orders in the immediate term.
And in the longer-term strategic picture, any specific call-outs there?
Strategically, KEI is highlighted once more. The view there is about its potential to scale up in the global cables and wires market. Rising export potential is seen as a really significant long-term structural opportunity for them.
So not just a short-term bounce, but a belief in their longer-term international growth story.
That seems to be the strategic angle, yes.
Okay, so pulling all these threads together, what's a final verdict from Goldman Sachs on Indian industrials right now? What's the main message?
I think the main takeaway is this idea of increasing divergence within the sector. It's not one monolithic story. Yes, there are definite short-term headwinds. The tariffs, the global capex slowdown, and those are hurting earnings expectations generally. But they clearly believe certain companies are positioned much better than others. Those with strong domestic demand drivers that are still holding up, or those with real export advantages.
Like KEI and Adani ports, which keep coming up.
Exactly. Those are the examples they seem to favor. So some are struggling with the macro environment, while others are seen as more resilient or having specific advantages.
And does that translate into a portfolio recommendation? How should investors think about positioning?
It does. Their advice is basically to be selective. They suggest being underweight, meaning holding less, of those industrials most heavily linked to the capex cycle right now, given the uncertainty.
And overweight what instead?
Overweight, or hold more of, select companies in infrastructure, cables and wires, and logistics, where valuations look more reasonable now and where the demand outlook seems more stable or has specific positive drivers.
So it's really a call for differentiation. Okay, let me try and summarize this for you, our listener. This Goldman report paints a picture of the Indian industrial sector navigating some pretty choppy waters right now, thanks to global economic conditions.
That's fair.
This means a more cautious outlook overall, especially for companies really dependent on new investments starting up. But, and this is key, it's not uniform.
Definitely not.
There are specific bright spots, companies benefiting from solid homegrown demand, maybe getting a boost from lower costs like fuel, or carving out niches in export markets.
Right. It's become a stock picker's market in this sector, it seems.
Absolutely. Careful selection looks crucial.
Yeah.
So maybe a final thought for you listening. What specific areas within Indian industrials do you think hold the most promise right now? Or maybe where do you see the biggest risks playing out in the next year or two?
Yeah, or even how might these big global trends, tariffs, slowing growth, specifically impact a business or an investment that you're keeping an eye on?
It's definitely a reminder of how interconnected everything is and how vital it is to understand these bigger shifts when you're looking at a specific sector, especially in a dynamic economy like India's.
Well said.
We really hope this deep dive into the Goldman Sachs perspective has given you some valuable food for thought. Thanks so much for joining us today.